Hey, I'm Ali Selby and welcome to Livewire's newest series, The Pitch. In this series, we'll be interviewing some of the country's top fund managers for their best ideas and insights. Today, we're very lucky to be joined by L1 Capital International's David Steinthal. His fund has outperformed the MSCI World Index by 12% since the beginning of the year, some really impressive stuff. And today, we're going to be learning about how he did it. Thank you so much for joining me today, David. I'm really excited to learn about some of your favourite stocks right now.
Great to be here, Ali.
L1 Capital International uses a quality rating system. Can you take us through the 5 criteria that you use?
Sure, we've developed a process that really helps us identify quality and risk. We break it down to 5 areas. We really focus on businesses and industries that have got really strong business drivers, things like increasing spend on cloud computing, electronic payments, aging population and increased healthcare, infrastructure spend or corporate management. So really strong drivers on the long term. And then that has to be dovetailed with a really consolidated industry structure. And we really like industries where they're just a couple of companies that dominate that industry. We call it Noah's Ark, really 2 companies that lead and maybe fragmented competition. And that really limits the degree of competition and enables them to continue to grow over time. The third is having a really strong management team. And we think that's absolutely critical. We'll spend just as much time looking at the past as trying to predict the future. We'll analyse how the companies have been operated, how management's allocated capital, how they've been incentivised over the past 10 years, because that's a really good indicator of how they're going to perform in the future. And the fourth area is financial. We're really disciplined around our valuation analysis. So we look for companies that have got strong free cash flow, not too much debt, improving margins and really high returns on their capital. And finally, we want companies that are on the forefront of addressing ESG issues. So they're really trying to position their business for the long run and attract and retain the best people by taking a leadership issue on those kind of ESG considerations.
You spoke to valuation a little bit there, but I want to dive a little bit deeper into that. How important is valuation to your process?
Look, valuation's really important. You can overpay for a really high quality business. So you need to get both right. But for us, you've got to get quality first and then we consider valuation. So it's quality and valuation, but it's got to meet our quality thresholds first.
But you pay for what you get in life, right?
Oh, to agree, but you can also overpay for some things as well.
Okay. What stocks do you feel like significantly contributed to that outperformance over the past 11 months now?
Yeah, sure. So, the fund's up over 30% this year. And what's really pleasing is it's been really broad-based contributors. Now, we invest in a whole range of industries, small cap companies like 1 to 2 billion companies, all the way up to like the biggest companies in the world. Some of the large cap tech companies like Microsoft have certainly contributed. But Booking Holdings, the largest online travel agent, owns Booking.com. That share price has almost doubled this year. Last year, the share price was trading at a crazy low price. It was lower than what it was if you go back to COVID days. Share price last year was lower than what it was after COVID hit, before we had vaccines. So in those days, we were all scared to leave our house and go to the supermarket. Last year, the market was just saying there's going to be a deep recession, no one's going to go on a holiday again. So that company's doubled almost over the past 12 months. And then even some of our cyclical businesses that are exposed to infrastructure and housing spend, particularly in the US, they've done really well in this environment. So it's been really broad-based.
What hasn't worked over the last 11 months or since the beginning of the year?
Yeah, so we really do think about downside protection. And pleasingly, the past 12 months, there's been really no significant detractors. The one area that's been a bit soft is healthcare equipment and services. A lot of those companies did really well during COVID times and there was a lot of spending on the healthcare industry. And some of that, what we've found is some of that equipment's sort of been repurposed. It was used for sort of COVID analysis and the like, and their customers have found ways to repurpose it. So the demands have been a bit softer. And coming out of COVID, China was really a strong growing market for those companies. And it's been really soft, which is really interesting. So those companies have disappointed us a bit. Not disasters by any means. They're still really good businesses. They've just underperformed a bit.
Okay, I'm very excited for this. What's your highest conviction pick for the next 12 months and why?
Yeah, so firstly, we have a conviction in our entire portfolio. We only own about 25 companies. Our top 10 is about 60%. So we have pretty large positions in all our companies. One of the companies that's actually just outside of our top 10, but the one that we've been adding to the most recently is HCA. It used to be called Hospitals Corporation of America, but it's the largest for-profit hospital company in the US. It owns about 180 hospitals, mainly in Florida and Texas and states where people are either moving to for jobs or a lot of retired people are moving there for the weather. So it's benefiting from population growth and also aging population. Older people go to hospitals more. And so it's just a steady Eddie compounding type business. You just need to believe what's happened for the last couple of decades will continue to happen. A couple of percent more people every year go to their hospitals. They're building new hospitals to support that demand. The price per hospital visit kind of goes up about 3%. It's kind of like inflation and a little bit because people are going to hospital for more complicated things. They're growing, so they're getting a little bit of margin expansion. They produce huge amounts of cash flow, so they're building new facilities, not just hospitals, but outpatient centres and those kind of things. So it can compound its earnings at like 10%, we think, for a very long period of time, trading on a P of 12 or a 6% free cash flow yield. It's like half the multiple of an Australian company like Ramsay Health Care. So we think that's a really safe compounding opportunity in this market, not very macro sensitive at all.
Okay, well, thank you so much for your time today, David. I really enjoyed this chat.
Great to be here, Ali. Thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.